Volatility, it's out there. It's in the news. Everybody is talking about it. I have to start with you. How does it affect us?
Well, it shouldn't affect us. We do what we can to keep the emotion out of the decision-making process and just kind of focus on the data.
Right. You always say it's all about the math, not the emotions.
It's all about the math.
So what are you doing to kind of put it all in place?
So volatility is actually a positive. It creates opportunities. It creates dislocation in the marketplace. We came out of a very much a beta-driven market the last 9 years.
Yeah.
If you owned the market, you matched exactly the market's return. And so what you've seen is a dislocation has created opportunities to buy individual names, individual stocks.
So you're saying that with adversity comes opportunity.
100%.
Yeah, be proactive as opposed to reactive. How does it change the client portfolios and the setups as you see it, Jeffrey?
A client's risk profile doesn't change overnight, but market volatility can. We try to take the emotions out of investing, and when volatility rises, so do the emotions on behalf of our clients. So we're looking to build portfolios that can withstand change, and in doing that, we're doing a tremendous amount of due diligence regarding real estate, asset-based lending, and equity option strategies that can really be a ballast in the client portfolio.
Well, let's go there. I mean, a lot of people love to talk about stocks and bonds, but here, and I know your team, Jason, at Lido, you're going deep into real estate strategies and lending strategies. And if the market volatility continues, how does that fit into a client portfolio and within their stocks and bonds?
So everything boils down to risk versus reward.
Sure.
And coming out of 2009, when you looked at the shadow banking market, banks stopped lending money, which created an opportunity for our firm to come in and act as the bank. So as an example, we were lending money in first position secured by real estate at about a 60% loan to value. So for every $1 million of value, we're loaning about $600,000, but they're not paying us 4%, they're paying us 9 or 10%. These opportunities only present itself in times of volatility.
So you're being proactive, saying, hey, it's not when, or if the next recession, but when.
Exactly.
I like it. Let's get back, though, to the volatility and to the liquid stock and bond market. How can you create a situation that you're hedged from these big swings in the market?
So the nice thing is that the markets afford us a bunch of different tools that we can use to provide our clients with protection, options and futures, for example. And here we've created a trade over the past few years that takes the guessing game out of trying to figure out exactly when the market's going to turn over, but still lets you participate in some of that upside while providing you significant downside protection when the market actually does turn over.
Cushion the downside, but have the opportunity to go up if the market goes up. So what we're saying is be nimble, have the cash flow, and to make sure that it's not a matter of if, but when the economy turns, that we're there and we're ready. I'm Ken Stern. It's all about your money. Lido Advisors.